Think about this for a second. In the late 1990s, an idea took hold that was so powerful it created one of the biggest investment manias in history. And then, poof, it was gone. $5 trillion just vanished into thin air.
So what on earth happened? Well, that's what we're here to break down. This is the story of the dot-com bubble, how a world-changing technology sparked absolute financial madness, why it all came crashing down, and what we can actually learn from it today.
To really get the bubble, you've got to understand the moment it was born. I'm talking about the moment the internet went from being this niche tool for academics and researchers to a wide-open digital frontier for anyone with a computer and a modem.
And the pace was just dizzying. I mean, in 1991, the World Wide Web shows up. Just 2 years after that, the first really user-friendly browser, Mosaic, makes it super easy to explore. By 94, you have Jeff Bezos starting Amazon in his garage. But the real starting gun, that fired in 1995.
Yeah, that starting gun was the Netscape IPO. Now, an IPO is when a company sells its stock to the public for the first time. And here was a company, Netscape, making almost no money, and its stock literally doubled on day one. That sent a massive shockwave through Wall Street. The message couldn't have been clearer. There was gold in this new digital world, and the rush was officially on.
What happened next was just a period of unbelievable optimism and absolutely explosive growth. The whole boom was fueled by this core belief that the internet was going to reshape every single industry on the planet. And nobody, I mean nobody, wanted to get left behind.
And you can literally see the mania in the numbers. Just look at this. The NASDAQ, which is a stock index packed with tech companies, rockets up from around 1,000 points in 1995 to over 5,000 by March of 2000. That's a five-fold increase in just 5 years. The market was completely on fire.
So what was driving all this? Well, it was a totally new and pretty seductive kind of logic. The idea was, forget profits, forget revenue. Who cares? All that mattered was growth. The thinking went something like this. Get as big as you can, as fast as you can, and the profits, they'll eventually somehow follow.
And this logic, it led to some truly spectacular flameouts. You had Pets.com, which spent a fortune on a sock puppet mascot but couldn't figure out how to ship a bag of dog food without losing money. Webvan burned through $1 billion building warehouses before realizing their whole model just didn't work. These companies weren't the exceptions. They were basically the poster children for the era's excess.
You know, looking back now, the red flags were everywhere. But in the middle of that boom, people just didn't want to see them. They were completely focused on a whole new set of rules.
And the most famous metric of all? Get this. Eyeballs. It didn't matter if your company was making any money. Not one bit. All that mattered was how many people, how many sets of eyeballs were looking at your website. That one single metric was used to justify billion-dollar valuations for companies that had never turned a single dime in profit.
This really gets to the heart of the disconnect. I mean, you had two different universes. Traditional business has always been about profits, cash flow, sustainability. But the dot-com era, it was all about potential and speed. The strategy wasn't to build a solid business, it was just to get big fast and kind of hope the business part would sort itself out later on.
Now, there were voices of reason out there. The economist Robert Shiller famously warned everyone about irrational exuberance. But in an environment where your neighbor was becoming a millionaire overnight by buying some random tech stock, caution just sounded like pessimism. Nobody wanted the party to end.
But of course, every party does end. And in early 2000, the music finally screeched to a halt, and the market began to face a pretty brutal reckoning. So what was the tipping point? It was really a 1-2 punch. First, the Fed started raising interest rates. That made it way harder for these companies that were just burning through cash to borrow more money. Then, investors started asking this really dangerous question. Hey, where are the profits? And once that seed of doubt was planted, confidence just shattered.
This was the absolute peak. March 2000, the NASDAQ hits its all-time high of 5,048. It must have felt like the top of the world.
And this was the bottom. Just 2.5 years later, the index had crashed all the way down to 1,114. That's a 78% drop. Trillions of dollars in wealth just gone.
The crash was absolutely devastating. I mean, hundreds of companies went bankrupt, people lost their savings. But what's truly fascinating is what actually rose from the ashes of all that failure.
And here's the crucial silver lining, okay? So the companies died, but the stuff they built didn't. All that money that was poured into laying fiber optic cables, building data centers and buying servers, that became the foundation for the next wave of the internet. We're talking about social media, streaming video, and the very smartphone that's probably in your pocket right now.
And a handful of companies did manage to survive the apocalypse. Amazon stock got crushed, it fell over 90%, but they adapted, they focused on the fundamentals, and they became a global giant. Amazon, along with others like eBay and this young company called Google, proved that you could build a real, sustainable business on the internet.
The crash also forced a really hard reset on the entire investment world. The focus snapped right back to reality. Investors started demanding more than just a cool idea. They wanted to see a credible plan to actually make money. The days of funding pure hype were over. Well, for a while anyway.
So this all leads to a really important question, right? Was this just some unique moment of madness, a fluke in history, or is it part of a much bigger pattern?
Well, history shows us it is definitely a pattern. From the Dutch tulip craze back in the 1600s to the housing crisis of 2008, it seems that whenever a genuinely new and transformative opportunity comes along, it often triggers these huge waves of euphoria where excitement gets totally detached from reality.
And that brings us to the final, most important lesson here. The investors of the late 90s were right about one huge thing. The internet was going to change the world. They were just dead wrong about how long it would take and what it was actually worth at that moment. The story of the dot-com bubble is this powerful reminder that there's a huge, huge difference between true, lasting innovation and a temporary frenzy of pure speculation.